Every once in a while, capitalism hits the brakes. Prices plummet, screens go red, and then silence. Trading halts. The world's most relentless machine is told to sit in the corner and breathe into a paper bag. It feels unnatural because it is. Who has the power to pause a panic? Why would a market that worships freedom of movement install a big red stop button at the exact moment it most wants to move? And when that button is pushed, does it stop a free fall, or does it simply freeze the terror in place, like a camera flash catching a runner mid-flight? This is the markets and machines historian, where money, power, and history collide, and nothing is ever as simple as it looks. The subject today is one of finance's strangest inventions: circuit breakers. Airbags for volatility, seatbelts for price discovery, safety rails mounted to a cliff we insist is safe to climb. The promise is simple: slow the panic, save the patient. The question is whether that promise is a cure, a tourniquet, or a polite way of saying, let's all take a breath before we continue screaming. The modern pause button has a birthday, October 19th, 1987. Black Monday? The Dow didn't fall so much as drop through a trapdoor. The autopsy read like a horror anthology. Portfolio insurance algorithms, sold as a way to hedge losses, all tried to sell at the same time. Specialists were overwhelmed. Their role as human shock absorbers collapsed under the weight. Phones jammed, quotes vanished. The speed of the fall wasn't information, it was malfunction. Afterward, the adults in the room did something radical. They admitted that sometimes the market can't be trusted to be a market. The principle that emerged was simple and heretical. When velocity itself becomes the threat, slow the game. If the floor is on fire, you don't debate the purity of price signals. You hit the sprinkler. Out of that came thresholds, timers, and a vocabulary of triage. In U.S. equities, the S&P 500 is the thermostat. A drop of 7% triggers a level 1 halt, 15 minutes in the penalty box. 13%, level 2, another 15. 20%, level 3, and the day is done. Lights off, go home, try again tomorrow. Time of day rules reduce theatrics in the final minutes, and single stock protections, limit up, limit down bands, wrap a guardrail around individual names. If a price sprints outside its band, trading pauses briefly to keep a fat finger, a rogue algorithm, or an empty order book from printing absurdity. Futures bring their own fences, overnight price limits that stop contracts from stampeding in the dark. It all looks very technical on paper. In practice, it is a confession about human nature. Liquidity is a fair weather friend. It shows up for the parade and vanishes in the thunderstorm. Quotes are not commitments. Depth is not bravery. When fear spikes, market makers step back, risk managers pick up the phone, and algorithms turn into mirrors reflecting everyone else's panic. Circuit breakers exist to manufacture friction when emotions outpace thought. Do they work? That depends on what the word work means. Take the flash crash of 2010, a market implosion and rebirth in minutes. It was like watching a skyscraper collapse and rebuild itself in a single breath. The postmortem was brutally honest. Liquidity is optional. It isn't a public utility, it's a business decision. When the sun is out, there are bids for days. When the clouds roll in, the book goes hollow. That event tightened the rules around single stock halts and birthed the limit up, limit down regime as we know it. Did that fix markets? It reduced absurd prints. It did not abolish the ancient truth that people don't volunteer to catch falling knives. Fast forward to March 2020, when a virus became a financial accelerant. The breakers tripped repeatedly. 15 minutes of quiet is not a vaccine. It doesn't change epidemiology. What it does is reduce the reflexive spiral. Price falls trigger risk models trigger selling drives prices, and the clock speeds up until action outruns thought. A pause throws gravel under the tires. It cannot turn a downhill into a climb, but a controlled slide beats a barrel roll. Compare that to China in 2016, a masterclass in how not to design a break. Bands were so tight that the rule itself became a magnet. Sellers rushed to sell before the breaker hit because they feared being locked out. The mechanism accelerated the panic it was meant to calm, and it was scrapped within days. Design matters. Rules too tight become a trapdoor. Rules too opaque become a rumor. Rules too politicized become a weapon. Across India, Korea, and other markets, you'll find variations on the theme: index halts, single-name bans, futures limits, sometimes commodity-specific rules that reflect local market microstructure. The pattern repeats. When thresholds are wide, known, and transparent, they dampen chaos. When they are narrow, unpredictable, or selective, they create it. The tool is less important than the trust in the tool. What actually happens inside a halt is the part the cameras never show. Public markets go quiet. Private markets get loud. Brokers whisper and DM. Risk committees convene emergency calls. Quant desks shrink exposures. Margin clerks rerun their models. The pause is not a meditation retreat. It is a war room with better lighting. On the order book, Depth that looked generous suddenly looks like a mirage when makers step away. Liquidity isn't the number on your screen, it is the willingness to transact when it hurts. During the timeout, firms decide whether they are brave, careful, or unemployed. Psychology becomes the main event. A pause forces introspection. Are you selling because your balance sheet is cracking, because a covenant is on fire, because your hedge is broken, because your boss is yelling, or because your neighbor is selling and you don't want to be the last one standing? Sometimes that snapshot breaks the spell. Sometimes it sharpens it. T. Of course, where there is fear, there are myths. Every wobble resurrects stories about a plunge protection team, midnight horsemen riding into futures markets, secret buttons pressed in gray rooms. Reality is more boring and more sobering. Policymakers do speak. Central banks do provide liquidity. Facilities get discussed. Repo windows open. And words like temporary do a lot of heavy lifting. That isn't a circuit breaker. That's policy. Slow, political, and full of unintended consequences. The breaker is a transparent rule, a published threshold, a visible stop, a timer everyone can see. Believing in secret rescues is comforting and financially dangerous. Replacing risk management with faith feels good until you need a bid that doesn't exist. If you zoom out beyond equities, circuit breakers are part of a long lineage of stop the bleeding moments. In 1914, as war erupted, major exchanges closed for months to prevent forced liquidation triggered by gold outflows. In 1933, the United States declared a bank holiday, freezing withdrawals to halt a run. Post-war currency crises brought capital controls and exchange gates to slow capital flight, all blunt instruments born from the same instinct. When confidence evaporates, time is the scarcest resource. Close the door, count the cash, reopen when you know what you've got. Today's circuit breakers are the refined version of those blunt tools. Minutes instead of months. Targeted pauses instead of total closure. Civilization learning emergency medicine after centuries of battlefield triage. Design still determines destiny. Good breakers obey 3 quiet rules. First, thresholds must be wide and well known. If bands are too tight or mysterious, they become magnets. People rush to exit, not because they want to, but because they fear they won't be able to. Publish the rails and keep them wide enough that ordinary pain doesn't trip them. Second, pauses should be short and fixed. Long enough to process information, short enough to avoid cues that amplify fear. Minutes, not hours. Hours, not days. Third, application should be universal across the ecosystem. If the index is halted, but options keep trading, hedges mutate into bets. If stocks are frozen, but futures are open, pressure migrates. Markets are not silos, they are plumbing. Block one pipe and the water finds another route. All of that is system design. Most people don't design the system, they live inside it. So the only sane posture is preparation. Assume liquidity lies. The size that looks friendly on the way up disappears on the way down. Size positions before storms, not during them. Separate signal from speed. A halt is a problem of tempo, not always a revelation of value. Ask what changed. Cash flows, covenants, solvency, or whether the only thing that changed was the speed at which you learned what you already knew. Respect the reopen. It isn't a tape resuming where it left off. It's an auction finding a level where supply will finally shake hands with demand. If you need certainty, use limits. If you need out, be ready to pay for immediacy. Watch basis risk. If you're hedged in derivatives while the underlying is halted, or the reverse, your hedge can become a speculative position by accident. During quiet tapes, rumors metastasize. The quieter the quotes, the louder the stories. Verify before acting. And pre-commit your rules. Write down the tripwires for de-risking, resizing, and exiting when the sky is blue. In a storm, your future self will not become wiser. It will become more frightened. Discipline is a bridge you build before you need to cross it. There's also a darker edge that the mythology of invincible markets has always been selective. We celebrate the days they soar as proof of wisdom and punish the days they plunge as evidence of madness. Both are human. Circuit breakers are not an insult to capitalism. They are an acknowledgement that capitalism is populated by people with thumbs, cortisol, bosses, and sleep cycles. The machine is powerful. The operators are mortal. The safety rail is not an admission of failure. It is a design choice in favor of continuity. Still, it's important to respect the limits. A well-designed breaker reduces the chance that one absurd print becomes a scar and that a malfunction of speed becomes a death spiral of confidence. It cannot change the weather. It can only stop you from skidding off the road while you figure out whether the storm is passing or the bridge is out. In that sense, the mechanism's success is measured not by green candles, but by the absence of headlines about irrevocable damage caused by a malfunction of tempo. There is a final image worth holding. Imagine markets as a city at night. Lights and windows are trades, the hum of traffic is flow, the occasional siren is a cell program. Circuit breakers are the fire doors and sprinklers. They don't make the city prosperous or moral. They make it survivable when a small fire threatens to become a conflagration. Sometimes they contain the blaze and business resumes. Sometimes they reveal that the building was already rotten and the morning brings a demolition order. Either way, they give firefighters and citizens a chance to walk out alive. So the next time the tape goes quiet and the anchors fill the silence with speculation, remember the simple logic behind the stop. Speed is the enemy of judgment. Panic is the mind outrun by events. A 15-minute pause is not cowardice. It is the price of wisdom in a system that moves faster than its participants can think. If confidence holds, a pause is a reset. If confidence fails, a pause is a preview. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.